only mode.
Good evening, everyone, and thanks a lot for joining. I know it's the time is very precious, and we'll ensure that we'll do justice to your time. So this is Abhishek Mehrotra, Head of Investment Products with HDFC Securities. We have as a guest Mr. Saurabh Pant. I'll give you a quick brief. Unfortunately, his because of issues we can't see on his webcam, but definitely we will be able to hear him and talk to him across the questions. There will be a presentation of around 20-25 minutes. During the presentation or by the end, there is an option to post your questions. So during the presentation or after the presentation, I'll request each one of you, so if you have any doubts, please raise your questions. I'll take you through Mr. Saurabh's profile. Saurabh has over 15 years of experience in Indian capital markets in the capacity of a research analyst and a fund management. He joined SBI Fund AMC in 2007 as an analyst covering sectors like consumer staples and discretionary, and currently manages few equity-oriented funds. Saurabh is a commerce graduate and holds master's degree in economics from University of Delhi. So thanks a lot, Saurabh, for taking out your time. And we have a lot of investors who have joined over the call. They want to understand what is a dividend yield fund all about, how it is different from the funds which are availing in the market, and request you to also touch upon how it is significant or different from the current themes where people do invest into large cap, and also what all is there. We will request you to take the investors through so that they can make a firm and informed decision. Over to you, Saurabh.
Yeah, thank you, Abhishek, for the introduction. So I'll quickly just run through. We got a deck on the fund, and then we'll open questions and make it interactive. So just to start with, I think Kamlesh, we can skip this because this is just how dividend yields are calculated. I think all of you are investors in the market, so I'm sure most of you are aware about that. Now coming to the key attributes of dividend yielding companies, right? I think Kamlesh, we can go to the next slide, which is similar to this but a little more informative. Yeah. So basically, companies which are profitable, are obviously have the capacity of paying dividends, and therefore, dividend paying companies are companies which with relatively stable business models, and they either can, apart from the capital appreciation that the stocks can give you, they enhance the return by way of giving dividends or by paying off or by buying back shares. The excess returns that they generate, and they don't need to reinvest, are essentially paid out in these two forms, and therefore they can increase the shareholders' yield. Yeah, Kamlesh, we can move to the next slide. Right. So this is just a snapshot in terms of when we compare dividend yield companies with broader indexes, how has been the performance, especially in periods of when markets have fallen significantly, and therefore we see that an index which comprises of higher dividend yield generally protects the downside a lot more than any other diversified index. So here, for example, in the chart here, you have the Nifty Dividend Opportunities Index compared to the Nifty 100, Nifty 150, and Nifty 250. Nifty Mid Cap 150 and Nifty Small Cap 250. And you can kind of see in periods where markets have inherently, been more volatile and have headed south, the Dividend Opportunities Index has been more resilient and has kind of outperformed in almost all of these periods except for one, and therefore it just kind of shows you that the businesses, because they are profitable, and I guess the volatility of profits is a lot lesser, and therefore they have a track record of paying dividends because the profit is lower on volatility, and therefore have been able to kind of protect the downside over a period of time. Yeah, Kamlesh, we can go to the next slide.
Yes.
Yeah, and again, so this is basically just depicting in terms of, when you look at the total return, which is a function of two things, which is the function of the share price going up and a function of the payback to the shareholders in form of dividend or share buybacks. So here you can see that in case of Nifty 500, where the total return has been about close to just over 12.5% over this 17 odd years, almost about 1.33% on a CAGR basis, which is quite a lot when you compound it over such a long period of time, has actually come from dividends. And similarly for other indexes, so it's ballpark, being in that 1.3 to 1.4% in terms of contribution. So almost you can say close to 10% of returns, has come from dividends. Yeah, Kamlesh, we can go to the next slide. Yeah. So I think this is just in terms of why I guess the downside protection has been more. If you make a portfolio of higher dividend yield stocks, it's essentially because I guess these companies have been more stable businesses, maybe more matured kind of businesses, and therefore possibly the growth rate could be a little lower, and therefore and have been more attractive in from a valuation point of view. So here we put out the Nifty the same index, the Dividend Opportunities 50 index. If in case of in terms of P, you can see it's far cheaper than, or it's on terms of valuations far lower than what you see the broader indexes to be. I think that's just in terms of the profile of companies. And the second part has been in terms of dividend yield being much higher, or almost 2x of any broad index, right? So essentially what we are trying to say here is that, this fund is an opportunity for an investor where you're looking for possibly lower volatility of returns, far more resilient in terms of from a downside protection, and therefore somebody who could have a risk appetite which is a tad lower compared to any diversified equity fund. Yeah, Kamlesh, we can go to the next slide. Yeah, this is just in terms of if you had invested 1 lakh rupees in this particular index versus the Nifty 500, you would have possibly gone 5.6x in terms of your investment versus 4.34 for the broader market. Yeah, this is just fact, right? So, but I think what I would like to highlight is that sometimes because of point-to-point comparisons, these data could look very different in different time periods. So that is something just I would like you to note. Despite the fact that this seems to be quite appealing, when you look at this period of last 15 years. Yeah. So now what we are planning to do in this particular fund is that, so almost 65, at least minimum of 65%, going up to almost 100%, would be invested in equities, which would be largely, where the filter would be, companies that have paid dividend, at least in one of the 3 preceding years. So essentially, we're looking for, stocks which have a track record of dividend payout, and the balance 35% can be invested, in instruments which are pretty attractive from a yield point of view, right? So, for example, REITs and InvITs, which are opportunities now for investors and have more compelling yields than dividend yield of the broad market in general, are also instruments that we would like to buy into this fund. And obviously, along with that, overseas securities, which we've been any which ways doing across our diversified funds at SBI Mutual. We have been investing primarily in US stocks. That is something which can also feature in that balance 35%. So there are certain geographies, outside India where dividend yields are more attractive. Even business models are a little more matured and resilient, and therefore are also investment opportunities. Yeah. Now, so the idea here, Rohit Chimpi is the fund manager, and the way he's laid out the strategy is that, the view is that we are essentially not buying the stocks with the highest dividend yield, right? It's not that we will kind of put the universe out there and just filter stocks on the basis of dividend yield, and the highest we just apportion money to the highest dividend yield stocks and be done with, right? I think his view is that uh, this just buying high dividend yields uh, as a consistent strategy may not yield the same results um as a diversified benchmark or as any other diversified fund. So growth is a very relevant part of uh, you know the equity market returns in India. We are still a fast-growing country, and therefore, the idea is not to maximize on the dividend yield. I think dividend yield is uh, more from a requirement of uh, buying robust business model which have the ability to pay dividends consistently, right? So definitely that's the filter to start with. But having said that, the idea is to also invest as any other diversified mutual fund scheme does in terms of buying stocks uh, and uh, being being more convinced on the higher growth outlook of those stocks, right? So this is not essentially, we're not saying that okay, dividend yield of the benchmark is, let's assume for example, 2%. We're not just going to buy the top dividend paying companies and therefore we want to keep the dividend yield of the fund at 4%, right? The idea is that okay, we will possibly have dividend yield higher than the benchmark, but the idea is also to balance it with growth, and therefore, like any other diversified fund does, buy good businesses, fast-growing businesses at reasonable prices, right? So I just wanted to make that clear. That's the portfolio approach Rohit has decided to take. Uh, Now these are certain examples where you can see that over a period of time, not sometimes we associate dividend yield companies to be either public sector enterprises or companies which are very very low growth companies, but they are exceptions, right? They are exceptions to this rule, and the idea is to kind of buy those exceptions. And these are certain examples. We've put a few examples out here where there are companies which have consistently uh, grown, uh, where the market caps of the companies or the share prices have gone up because the earnings of those companies have grown and have also have been paying dividends, and dividend yield is a very material part of the overall shareholder return. So this is one example of a power transmission company, where you've seen consistent growth in the stock price. Sorry, the previous slide, Kamlesh, just finishing that, where you see the consistent growth in share price or the market cap, which is the histograms, the gray histograms that you see here, and also you can see the dividend yield on the uh, on the right hand side, where you see very very handsome dividend yields despite appreciation in stock price, right? So we can move to the next slide. This is another example of an IT company, similarly growth in earnings, growth in stock price with decent dividend yields, right? So uh, next slide, Kamlesh. Yeah. Uh, so this is something where we've kind of discussing the
So I'll take the.
yeah, Kamlesh, you can take the
Yeah,
tax
yeah.
arbitrage part. Yeah.
So friends, we have an option of, we call it SWP automatic, wherein a person say invest 10 lakh rupees and we are giving him an option of 6% withdrawal every year. So a person who invests say 60 lakh rupees, sorry 10 lakh rupees, and he has an SW option, he'll withdraw 60,000 every year. So at the end of the day, when he withdraws 60,000 rupees, so entire money doesn't go as his capital gain. There is a some amount of capital gain and some amount goes from his own unit. Own units are redeemed. So when we did this back testing for 10 years, 15 years, and 5 years on Nifty 50 DRI index, we found it has beaten way above the, we showed you in the above first example of with 4.5 lakhs and 5.5 lakhs. This index has given way above return through the form of SWP. A person who is looking at a regular income over say uh, cash flows in his kitty, this product is very good for such person. Secondly, we know post what do you call last budget after 2019-20, the dividends at the hands of investors are taxable. Whereas when you go through an SWP option, the tax is very marginal. We have done a lot of back calculations. It hardly comes to 2.89, wherein if you are in highest tax bracket, you get your tax returns are almost 36%. For example, if I am getting a dividend income over 5,000 in a year, I'm taxed as a marginal rate, wherein if I go in a SWP option, there's only a capital gain. The capital gains are taxed at only 10%, with plus it comes to 10.9 or something percent. So any day dividend option is a SWP option is a very good option. A person who is looking at a regular income, he should go for this kind of fund. Saurabh, you can take over from.
Yeah, I think just to add to Kamlesh's point there, I think the arbitrage there is the tax part, right? So as mutual funds, dividends, when dividends accrue to us, it's not taxable and we don't pay taxes on it. As direct shareholders, you will have to pay taxes on it. So I think that's where, which creates that differentiation in terms of returns, right? Now, just coming back actually, so this is another fund that we've launched, to obviously something, possibly there's an appetite, there's a set of investors out there, and also to complete our bouquet of funds, right? But I think for the fact that I'm saying that at SBI Mutual, I think our strength has been more about the processes that we've set in, and I think dividend yield fund is and Rohit in particular who's going to manage this fund is also going to depend a lot on on our bandwidth as an investment team, and so do the other fund managers, right? So it's more important to understand about the the depth and the width that we've created in our investment team. So these are a few things that we just wanted to touch upon. The first one being primarily SBI Mutual Fund was a fund house where, I mean, obviously, I've been here for about close to 16 odd years now. Primarily, I would say in the first 10 years of my work here, we were a house where we were spending a lot of time in stock selection, right? Where to try and find ideas which can meaningfully outperform the markets and therefore do a good job in terms of identifying those ideas and sizing them up and buying them in the portfolio, right? So, but I think over the last, I would say, over the last 5 years, 6 years, 5 to 7 years, I would say, we've also kind of evolved and created, a macro asset, allocation framework, where now we are launching funds. We are taking views on all asset classes. So we have a view on equities, we have a view on fixed income, we have a view on gold, and we are also now, launching products based on that. So one is obviously giving investors new products to experience, and second, I think with this framework, it's also helped your equity funds because it helps us to kind of take I guess move the direction of funds or give tilts to the funds depending on our views on the markets, right? So it also helps creating portfolios and curating portfolios depending on what view we have on equities in general, right? The second, obviously, is bottom-up research. That is something which we've always done. The only thing is that we've added more people and people under them, so that over a period of time, our coverage universe has really gone up. Right, we almost cover now more than 350 stocks, and therefore, uh, you know, most of the research analysts that we have large significant amount of experience. I think all the lead analysts have an experience of at least more than 10 years. They're analysts with 18 years of experience. And we've created a second layer under them, so that they have enough bandwidth, because our coverage universe has been going up. So this is something we've always done. We've only made it, I would say, a little stronger. And then we've last few years, we've also added ESG framework. Uh, Rohit also manages, the ESG fund that SBI Mutual Fund has. And this ESG framework is where we are now much more involved, uh, uh, from an ESG conscious point of view, and also now involved with companies in terms of, improving, their own, scores, whether it is governance, whether it is, the environment. So we've been working on those aspects. We have a dedicated team of ESG analysts in house now. Uh, then also we've also built we have a quant team now. We also have been curating quant portfolios. Uh, so so if I'm a portfolio manager at SBI Mutual Fund, this is one of the tools which is at my disposal. This is basically, you know, uh, it's something based on fundamental parameters. So it's a four framework. It's got a four uh, uh, pillar approach. So where we're looking at earnings, we're looking at quality of companies, we're looking at uh, the price momentum, and we're looking at valuations, right? And all these four factors have more sub factors under them, and we are ranking companies on these parameters, right? And once, so we do it over the top 200 companies, and then the quant team comes up with their own curated portfolio uh, in terms of the best top rated companies on these parameters. Is something we've been running for some time. So as a portfolio manager who's doing a diversified fund, or for example Rohit doing dividend yield fund, he can use this particular framework and possibly also tweak this framework. Maybe possibly he's looking for uh, companies with this framework with a dividend yield parameter, and therefore at any point in time this is a live portfolio. It's a live screening. It keeps throwing companies, and so out of the 350, or let's say out of the top 200 stocks, you can curate a portfolio of top 15, 20 stocks. So this is something which is we've developed. Uh, uh, and yes, a multi-factor model is also, uh, you know, is a function of the asset allocation framework, where we are now taking calls across asset classes, and we have, one of the funds, or actually two funds, which are now making use of this. Yeah, we can go to the next slide, Kamlesh. I think you jumped a couple of slides. No, I think the one before this. Yeah, sorry. Yeah, so this is something where, this is the ESG portfolio cluster. I think we can skip this, Kamlesh. Yeah, we can go to the next slide. Yeah, so this is, the previous one, I think, just to sum the investment process. Yeah, so this is something I would say, which is the end-to-end process, right, where you generating ideas. Yeah, one thing I didn't talk about is scuttlebutt. It's something we've been, again, over the last few years, we've developed. All analysts have been doing significant amount of challenge checks, and I think this has become very, very relevant now. I guess, because uh, there has been so much of participation in equities, and therefore excess return is hard to come by. it's something I think channel checks or scuttlebutt is something which has become so much more relevant in terms of being a little ahead of others, and also identifying investments which can go dud, or where there can be issues. I think this is something we focus a lot on, and I think the others we've talked about. Uh, Investment thesis. So there are a few things on the process side which I can touch upon if there are certain questions. But broadly, what I would like to say is that um, even on the research side, there is a lot of qualitative output you get from research, right? Which could be in forms of discussions, etc., with analysts. But we've tried to organize all the research output in a more quantitative base. So we have a knowledge management system where the analyst has a live recommendation, has his or her target prices for 1 year, 3 year, has a model in place with forecast for at least the next 3 years, and has a valuation methodology in place, right? But what we've done is that uh, apart from that, we've also given a lot of uh, ownership to the analysts in terms of, so the analysts now are giving their high conviction bets. So out of the 350 stocks, we have about, I think, 75, 80 odd stocks, which are high conviction buy ideas for the analysts. And we are ranking those both in terms of uh, the expected return from those stocks that the analyst expects, and the confidence score. So a combination of those two have been we've put together and curated portfolio. So we have a small cap model portfolio, mid cap model portfolio, large cap model portfolio, right? So as a portfolio manager, let's assume for dividend yield fund, if I was the fund manager, one is the quant output I can go to. Second, the fundamental analyst, the analyst team, their output in terms of high conviction ideas is curated in these three buckets. That is the second thing I can go to. The third, I can take a call on the market direction based on my multi-asset or multi-factor, multi-asset allocation model, where we're taking calls on those asset classes. So these are, I would just say, tools available to a fund manager to go to, right? And basically, this is all these have been put in place because a single person can make, can commit more errors, or I would say a single person can have behavioral biases, etc. So therefore, how do you put a process around it so that the performance is a lot more consistent, the errors are a lot lesser, and our approach, though you want, finally you want a portfolio manager to kind of put it together, and give a free hand to, but how do you really create a process around it so that that particular portfolio has more tools to go to, just to ensure more stable performance, right? So so then is the portfolio construction and execution involved. We can go to the next slide. Yeah, I think now I think away from the reasons, and we talked about how this fund will be positioned, it will be like, I would say, a diversified equity fund with a filter of buying companies from universe who have been consistently paying dividends, and not the approach of buying, as I said, not buying the top dividend yielding companies. Uh, and I think uh, and we've talked about the generally the bandwidth, the process in the fund house. For that, it will be style agnostic. Uh, uh, and it will be based on bottom-up strategy. And yeah, I think we've covered most of these points, right? In terms of how this portfolio will be positioned. Uh, yeah, we can go to the next next slide. Yeah, these are just some of the
Yeah,
arguments
or we can. I think
for.
we are running out of time, so maybe we can. You can stop here, and you can
No, I
speak
just wanted
something.
to add one more. I just wanted to add one more time. I think I think one pertinent question would also be in terms of why we are coming out with this particular fund at this point in time, right? From a timing point of view, I think this one. So I just wanted to share our thoughts on equities in general. So as I said, we've been taking calls on these asset classes. So equities for us is an underweight right now. We are cautious on equity markets. Uh, we are overweight fixed income, so we like fixed income as an asset class at this point in time, and we are overweight gold, right? So I think we are in stage now. Why we are negative equities? I can, in case somebody is interested, we can go through that. We have uh, basically there are four pillars for equity return, right? So one is earnings growth, one is valuations, one is liquidity, one is sentiments, right? And I can talk to you about our view on all those four parameters. But in short, we are cautious on earnings. We think earnings growth has been uh, very solid for the last 2 years. But now we are seeing some deceleration that is happening. That's one. Second, on valuations, Indian equities is looking a lot more expensive versus to its own history, versus to other countries, versus to other emerging markets. We also have a more evolved valuation framework where we compare the earnings yield to bond yields and you know decide whether earnings are attractive versus other asset classes. And even on those counts, it seems valuations are more expensive. Uh, uh, on liquidity, we think liquidity conditions are a lot tighter than what they were a few years back, and there was a significant amount of liquidity, just not in India but globally, that was available over the last 2 years, and it has also shrunk at the same pace. And therefore now we are at a point where we are back to those pre-COVID levels in terms of liquidity. Cost of capital obviously has gone up. And the last, on the sentiment, we also have a sentiment index that we have in house, which is based on a lot of factors, but it's also covering factors like your Google searches, for example. Um, in terms of if people are searching for more multi-baggers, etc. It tells us that the market is hot, and therefore it's a contrarian signal. So when there is a lot of optimism in the market, for example, from the search data point of view, we get a little cautious. So that's one of the parameters. Then there is parameters around the primary market in terms of how many IPOs are coming, what's the primary activity, activity like, is it, are there too many IPOs which are getting sustained, etc. Again, we take a contrarian view on that. If it is too hot, then we would be a little cautious, etc., and the other way around. And similarly, there are other factors, right? So on the sentiment index, we are somewhere neutral. So I would say earnings a little cautious, valuations expensive, liquidity a little tight, sentiments neutral, and therefore we have a cautious view on equities, right? And therefore dividend yield from that point of view, from a timing point of view, is something which we thought uh, we should offer to the investors. So this is somewhere, as I've shown in previous charts, it's something which has prevented downsides and possibly been a little lot lesser in terms of volatility, and therefore I guess is a product you know um, apt for possibly the current circumstances. Yeah, Kamlesh, I think Abhishek, I'm also kind of done. We're very happy to take questions.
Abhishek, you're muted. Abhishek, you're muted.
No, Abhishek, we can't hear you still.
You can talk, Abhishek, now. No, but we can't hear you, Abhishek. Operator Abhishek, we can't hear.
No, Abhishek, we can
Abhishek,
see you.
I can
Unfortunately,
see
can't
your
hear you.
icon, but I think your volume somewhere something is wrong. We can't hear you. Maybe your laptop volume or something.
No, it won't be a volume thing. It's a microphone thing.
नहीं
Yeah.
लैपटॉप उसने बंद रखा है शायद.
So just a sec.
Yeah, we can hear you now. We can hear you now, Abhishek.
Abhishek, yeah.
Okay, perfect. So I'll quickly take on their some questions which are there, and so I'll quickly first, before taking on the questions, I'll just summarize for the benefit of all the clients who have joined. So what we are talking about is a dividend yield fund, and as Saurabh has clearly mentioned, dividend paying companies are majorly mature and stable companies with decent valuations, and or more reasonable valuations, I would say, and less volatility. In fact, is also shown us a graph which shows that high dividend companies have limited downside. There are only two questions which I could which I can see right now, Saurabh, is one is what is your expected, what is the sector spread which you want to keep in the overall portfolio as in the current.
Yeah, Abhishek. So this is sector agnostic, Abhishek. Just to give you a profile of, so the benchmark is going to be NSE 500. But if you look at the NSE dividend yield benchmark, which we have data for on the slides that we just shown, I think there is a significant skew in that benchmark towards IT, towards energy, and towards consumption, right? Those are the three sectors where the skew is. So I would say that's not the benchmark for us, but I would say I think there will be a skew in the fund towards these three sectors because I think that's where more stable businesses are. That's where there has been history of consistent dividend payouts.
Okay. There is a question of expected dividend yield for the Nifty FY23 and 24, and what is the projected? What do you expect the fund to be? How the fund to be performing over long run? Obviously, short run, I'm sure it's a tough call for everybody. But how do you see the fund performing over a long run? And
right,
you want to take that?
So Abhishek, on the dividend yield, maybe I can give a number. But I would like to definitely look it up and vet it. But I think the dividend yield for the index, if you look at the Nifty 50, I think should be forward dividend yield should be, I think, ballpark 2% or maybe a little lower than that, right? I think
it's
ballpark.
1.7, and we are targeting 2.5. So we are targeting 50% to the benchmark. Plus,
right.
someone is asking what is the
1.7. Sorry, Kamlesh, 1.7 is on financial year 23 earnings, is it?
The previous financial year.
So I think the investor is asking on 24, 25. So it'll be somewhere close to 2, right?
Yeah.
On forward numbers. Yeah, sorry, Kamlesh, go ahead.
Yeah. So for the fund, we are targeting 1.5 times the benchmark dividend yield. Plus, what I was saying is this fund is very good when the markets will be, say, range bound, or when the markets are falling or something like that. We showed you 5 data points when there has been a meltdown in the markets in last 17 years. So this fund has always fallen less than any of the indices, and
right,
the height of this fund is for a long period. This fund has always given you very good returns. So it has beaten all the benchmarks over a long period of time. Maybe in short term, this fund might not give good return because this will not have very what you call growth stocks. This will have mix of blend of value and dividend paying companies. So till we see what we can see, all the evolved companies, maybe the names we can throw, that is TCS, Infi, then you have FMCG good stocks who are continuously paying good dividends. You banks, they give you good dividends, and last but not the least, some power utility companies. So there will be a mix of all of these companies, and most of these companies, they are consistently paying dividends. Plus we are also looking at companies who have, we showed you 2 examples. There is a continuous dividend, plus there is a growth in dividend. So for example, this year I'm giving 5 rupees dividend per share. Next year I'll be going 5.5, 6 rupees. So both the things, so my capital should appreciate, plus my dividend should go up. That's how we are looking at constructing our portfolio.
Abhishek, just to add to what Saurabh here, sorry, just to add to what
Yeah.
Kamlesh is saying, right? And I think this question is very pertinent in terms of over long term, how do you see the returns of this fund, right? See, and I actually put a, I just wanted to put a note when we were showing the point-to-point return from 2005, I think it was till 2022, right? Or 2007 to 2022, last
2007.
15
Yeah.
years. Yeah. So I think what happens with these point-to-point is that, it always differs. If I take a different point in time, the return could look different to what we just showcased, right? But the idea here is, and I think you also have to, and I would want to put this kind of a, not a clause, but I just want to put this, upfront, is that uh, the way the markets have, I mean, the flavor, I would say the market performance, if you see over the last 10 years or so, right, has also skewed towards, uh, I would say more quality growth rather than more value and momentum, right? If you let's assume have if you put different styles, which is say momentum or value or quality or
Right.
growth, right? There has been a skew, or the performance of quality slash growth has been better in terms of performance versus momentum or value, right? And therefore, I would say, or take momentum out actually, just compare it to value, right? And therefore, I would say uh, investors, when they are looking at last 10 years, should not just get swayed by that, right? There is obviously a style drift which has favored this kind of investment, right? And I would say in short terms, when we are a little cautious on markets, definitely from the next 1 year point of view, this could be a fund which could look better or more stable, when inherently we are talking about, or when our view is that things be more volatile, and things could be being more volatile, it could also be downwards in equities. Then
Right.
therefore, this, I would say, this offers a more a better risk adjusted performance, at least in the short term, right? And let's be clear about that. I would say that's our view, right? Now over longer
Got it.
periods, you might just have a different style drift. You might just have value growing faster, for all you know, next 5 years, right? And
Right.
therefore, maybe the dividend yield, typical dividend yield stocks, which are what Kamlesh was saying, IT or consumer, may not be the top chart performers, right? And
Right.
therefore, we should not just think about next 1 year or next 5 years. I think we got to think about it the next, say, 10 years or 15 years, right? And I think from that point of view, these businesses inherently are more solid. They have more competitive advantages, and therefore they become stable, right? Because they've had those competitive advantages, and therefore you could say they are a little more matured, have therefore more moats around them, etc., and therefore more reasonably priced more often than not, and therefore, and these could be across mid cap, small caps, right? They can be small categories uh, of businesses, but they could be certain company which could be dominating those categories, right? So
Right.
it's not necessarily it has to be a large cap. It could be a small cap, but it could be more matured within that category. It could be more dominant
Got
in
it.
that category, right? And therefore, the idea is to have a good stock selection across all this. And
Right.
therefore, we just don't want to. That's why we don't want to make it a very high dividend yield fund, right? Because then you are really going to a very um, a significant style drift. So the idea
Right. Right.
Rohit is saying is that, okay, we want companies with dividend yield, but we also want to look at growth, because somebody who comes
And
in now
that's what
looking at,
investors are looking forward for that the overall NAV growth should be there, or overall the fund performance should be there, not specifically
exactly,
coming from which stock, but broader theme is dividend. But yes,
right,
I can pick out what you're trying to say. So I think this was the last question. In fact, during this discussion, you also touched upon one of the question which came up, that why not a pure equity fund and a dividend fund. So the investor who has asked this question, just a simple suggestion, sir. Look, if you're going for a very aggressive kind of a strategy for your investments, the objective is that you can go in for, a highly diversified but concentrated funds like focus funds, or large cap, mid cap, and small cap funds. If you're okay with a stable growth, a much more mature kind of a business where you want the fund to participate a relatively a lower volatility, this fund will definitely make sense to you. If you want more information, you can get in touch with our relationship manager for our detailed product note. The fund is available on the website and our mobile app in the NFO section, and so anybody who wants, you can apply. The fund will be closing on 6th, but I'll request, if you have funds, don't keep it idle. You can invest fact today also. So the fund will close on 6th with HDFC Securities website. And if there is any further questions, since we are moving out of time, you can mail your questions to your relationship manager or to us, and we will get back to the fund house and answer you back. And thanks everyone for joining. Since we have moved ahead of time, I'll close this call. And thanks a ton to Saurabh and Kamlesh, who have taken time to present this fund to all our investors. And thank you once and all for all the clients who have joined, and happy investing to you. Thank you, everyone.
Thanks, Abhishek. Thanks to you.
Thank you.
Thanks,
Operator,
Saurabh.
we may close the call. Yeah, thank you.
Yeah, all right.